It is the 1st of May. Right, dollar index. Obviously, you can imagine my frustration yesterday when, having broken above the previous 1, 2, 3 triple top high and this trend line joining them all. Not only did we close above it, we closed above it for 1, 2, 3, 4 sessions, including a weekly close above it. So I was convinced that this was the bullish breakout I had been waiting for literally months, and noticed that since January we have been actually in a bull trend anyway. So the break above there was just confirmation that this bull trend was going to continue. Right, that didn't happen. So very, very frustrating. We broke back below the previous highs and the trend line, and we had a big plunge in the dollar index, as you can see, nearly 50 pips, certainly 45 pips. So now you're all probably thinking, okay, he got this wrong. It looks like we're going to remain in the sideways trend and probably continue lower. And I'm going to be very stubborn here, but I really, maybe stupidly, I'm going to stick with the bulls on this one, for the fact that we are in a 4-month bull trend. Now, I've seen breakouts like this too often to know that as soon as I stop myself out, the bloody thing turns around and rockets and does exactly what I thought it would do. So here's my argument for today. Okay, it is FOMC day, so it is all down to what happens in the minutes, and that is a pure gamble, because obviously I've got no idea what they're going to come out with. And I know there is talk of a rate cut, which I think is absolutely insane. But that's, I'm no economist. So we have a trend line going back to the beginning of March. We have both two trend lines, beginning of March, middle of March. You see, this one is a steeper upper trend, as I thought the bull trend was accelerating. So that's what tends to happen after the initial period. As the market turns, you then get an acceleration of the bull trend after a more sideways period. So this is what I thought was happening. Now we're coming back to test that trend line, which will be around, in the dollar index, 97.35. We've got that lower trend line, less important, at 97.30. We've got the midpoint of the Bollinger Band at 97.40. So 97.40, 97.30, I think, is good support. And we have now unwound the overbought situation in the slow stochastic. There's no reason why we can't just turn around from here and head up. So I'm stubbornly sticking with my bullish argument, even though I know you guys have probably been stopped out of all your dollar longs now after what I wrote yesterday. So you won't be happy. The hourly chart paints quite a bullish picture. You can see a very clear bull trend. Okay, it's only 6 weeks old, this bull trend, but it is a steeper bull trend than we started the year, the January to March period. Now, we've absolutely just nailed that lower trend line and have held it at the moment. You can see we've got decent confluence of fib support at 97.35, and we've got 500-hour moving average creeping up to 97.35. So there is a lot on the daily chart around the mid 97.30 area, and there is a decent amount on the short-term chart around the 97.35 area. I can tell you on the 4-hour chart we've got the 100 period moving average coming in there as well, which kind of makes sense, doesn't it, when you've got the 500 period moving average on the 1-hour chart. There's my argument. My argument is that this will hold and we will rocket, and probably go up quite quickly, because I know a lot of people were thinking along the same lines as me. A lot of people were waiting for that breakout, and a lot of people will have got stopped and will now have given up and may even be short. This is my theory. So the euro went horribly wrong for me yesterday. I had a resistance level at 111.85.95, stops above 112.15. So unfortunately we were stopped out of our shorts there. You can see we've hit the midpoint of the Bollinger Bands at 112.33 was the midpoint, so we missed it by 3 pips. You can see that we're no longer oversold. That's been unwound. So similar argument that I'm seeing in the dollar index. You can see, of course, that we are in a negative trend for this year, and really for a lot further back when you look at the weekly chart. We're clearly in a very negative trend, and the idea is to trade with the trend. I see no reason why strong reason why we bounce from here. So I think this is just a bounce in a bear trend, although I obviously am surprised that we beat the previous lows down here, and even this spike low down at 112.13 we beat. So that was a surprise. That's why I had my stops above 112.15. Now again, on the hourly chart, we do have that bear trend going back 6 weeks like we have in the dollar index. So the euro has now beaten what I thought would hold. But you can see I had a sell up here as well around the 112.40 area on the report and on the spreadsheet, and this is why 500-hour moving average, decent trend line resistance, overlapping fibs. You know, this is the perfect short scenario for me in a bear trend. That is what I'm looking for every time as a low risk trade. So I do believe that, well, unfortunately we didn't get there, so we couldn't sell it. But clearly the resistance is working in some respect because we got to within a few pips of it, well, 10 pips of it, shall we say. And I'm stubbornly going to sit here with my bearish hat on. Aussie dollar in a negative trend for over a year now, as you can see, even after the bounce back from this rather weird spike low in the 1st of January. I've had a negative outlook on this ever since we shorted it up around the 200-day moving average, of course. I didn't predict this bounce, although I did spot the fact that that was a neutral candle and that we could have a short-term bounce back. But I'm going to stick with my negative outlook for this too. In the short term, the fibs are working. So the 38.2% fib at 70.70 worked. And you can see that the 70-40, 70-30 area as support is also working. But I think we will break down. So if you're still holding shorts in this pair, I think you look all right. Just checking my spreadsheet yesterday, I did have a short at 70.65, 70.75 with a stop above 90. So fortunately, that did work perfectly with that high pretty much bang in the middle of my sell range. So yeah, I'm happy to stick with shorts on that one. If you sold that up there yesterday, I think, well, obviously we need to break below sort of 70.30, 70.20 for that to really kick in. New Zealand dollar versus the US dollar is another pair that I have been negative on for quite a while, and it has worked because obviously we have been going lower. Now look, I had us getting into a short at 66.65, 66.70, which was a little bit too low. I had a stop at 85. Now I believe with the high yesterday was 84. So hopefully, by the skin of my teeth, I've managed to keep us into a short trade there, and the market has fallen off again. The fact if we can hold below 66.50 today, that would keep the outlook negative. So again, I'm sticking with my strong dollar, US dollar, weak Aussie dollar, weak New Zealand dollar outlook. I've got no excuses for the Canadian dollar. I thought that we would hold this support in favour of the bull trend, which has been running for quite a while. Again, thinking of a stronger US dollar. I was just plain wrong here. So the buy at 134.30.20 with a stop at 133.95. Well, obviously the stop's activated. I've got no clue what to do with this now, so I'm just going to have to leave it. British pound has also completely fooled me, to be fair. We broke below the 100 and 200-day moving averages. I saw that as negative. We bounced from here. I've no idea why that held, and we absolutely rocketed since. So shorts at 129.55.65 were stopped above, or were stopped at 129.85. This actually, I think, looks pretty positive, to be fair. Even the short-term charts look okay. I'm going to have to leave it alone, but I certainly wouldn't be short anymore. Again, it's the short-term 6-week pattern in cable, pound versus the US, which I think is giving us the clue. This looks bullish. We've broken above a trend line. Looks pretty good. I'm going to leave it alone myself, but if you are trading it, then note that the fact that we've broken above it. Green line is the 500-day moving average, and we seem to be, well, as I speak, we're holding above it anyway. If we break through the 38.2% fib at 30.62, 130.62, well, I'll call it 130.60, 130.70, then that's going to look more positive again, and we can run up to 131.20. So we've obviously got support down here at 129. Well, that's where my stop was yesterday, above 129.85. So we've got support down here at 129.85, 80. Looks like these are going to cross over in a bullish pattern as well. Gold I found a little bit more confusing lately, but we are clearly in a 3-month negative trend, and we are holding what could be the neckline to a head and shoulders here. As well, you know, in fact, yesterday we topped again exactly at that 1286, 1287 level. We've got the midpoint to the Bollinger Band there at 1285, 1286. So there's a lot going on in that mid 1280 area, which is holding it in the negative, in the short term negative trend anyway. Obviously, the trend is bullish in the longer term. And a move below the first support level at 1276, 1275 will be negative again, of course, and I don't see any reason why we won't come down here to 1268, 1266 and test that support level, which coincides with the lower Bollinger Band as well. If gold pushes above the high this week at 1288, 1289, we should head up quite quickly to 1293, 1295. I'm going to call it maybe 1296. But you can see that that area will, by the time we get there anyway, this 100-day moving average will be above 1293, and this will be 1296. So we're going to have to get up through 1296 for a buy signal for us to break out of the short-term bull trend. Oil has been difficult. I didn't expect this. I expected perhaps a pullback, but not such a big collapse last week. We've had a bounce back. We certainly had a good bounce back this yesterday to the trend line, which goes back to January. You can see that we just touched that trend line, that resistance level, and we've come back quite sharply from there. Looking at the hourly chart, remember I talked about a potential head and shoulders pattern here. So this trend line is not particularly relevant. No, maybe it is. Maybe it is. This is the neckline to the head and shoulders, so we've got to watch it around $62. A break below $62 will complete the head and shoulders pattern. Now, the fact that we held the 200-hour moving average increases the likelihood that this is a head and shoulders pattern. So I'm starting to lean to a negative bias, but we don't sell these patterns until we get confirmation of a break below the neckline. I've done that too many times, thinking that this would definitely happen and lost money. So you've got to be patient and wait for this. In the meantime, we've got resistance at 64.00, 64.10. If we get up through, and then again sort of 64, 65.75, up through there is more positive, and oil can run up to this area here around 65.35, 65.55.